The last video discussed prepaid and unearned stuff, so cash had already changed hands. This video is going to focus on accrued expenses and revenues. So for an accrued, the liability or the expense is already fixed. We know what we're going to have to pay. Or the revenue is already fixed. We know what we're going to earn. The only thing that has to follow is the cash payment. So as such, we're going to go ahead and journalize what should transfer when payment is eventually made. Salaries are the first thing the book talks about. And as I have said in class, the reporting period will likely fall when we owe our employees some money. Right? So they've earned it, we just haven't paid them. So let's assume we owe the employees $550 in salary by the end of the period, okay, that has not been paid. So if this is the case, we're going to debit our salaries expense and we're going to create a payable. And right now we're just going to call it salaries payable. We don't have to get very creative, right? We're accountants. If we get creative, we end up in jail. So we're going to debit salaries expense and credit salaries payable $550. Now from our trial balance, we had $2,800 in prior salaries that had been earned and paid. And this $550 just adds to the salaries expense. So we end up with a final salaries expense of $3,350. Salaries payable, right, trial balance, we didn't have anything on there. So we had this adjustment in, and we're going to add $550 to our liabilities. The next thing the book covers are utilities. We're generally billed for utilities after we use them. Right? They don't necessarily know how much water we use. They don't know how much electricity we use. They don't know how much natural gas we use until the month has been completed. Right? But that expense should be applied to that period, regardless of when I receive the bill. Right? The electricity was used in December. The gas was used in December. The water was used in December. So it should be added to December's report. So let's say we end up getting utility bills a total of $2,000 by the end of the period. If that's the case, we're going to create utilities expense of $2,000 for our debit and utilities payable for $2,000 for our credit. Interest is compensation for our lenders. As soon as they loan us money, as soon as they give us the cash, or as soon as we give someone else the cash, if we're the lender, interest starts accruing. As soon as the money is lent, interest starts accruing. So, if I'm borrowing money, as soon as I get that cash, I start generating interest expense every day. If I loan the money, interest revenue starts being generated every day. So at the end of the period, we will look and see what loans do we have outstanding, what debts do we have outstanding, what's the interest rate on them. Let's adjust for the interest expense. Let's adjust for the interest revenue. So we're going to focus on interest expense here. Back in the last chapter, we borrowed 10 grand. They're going to charge us 12% on the note because we're relatively risky, and the note's been outstanding for 2 months. Right, to calculate your interest formula, you'll always use the same formula. What's the amount of the loan? In this case, 10 grand. What's the interest rate in annual terms? 12%. And how much time has it been outstanding this period? 2 months. So if we look, our interest expense calculation should be the 10 grand times 12% times 2 over 12. So $200 is the interest expense that has accrued since we borrowed the money. Here's our journal entry in our T accounts. Interest expense is debited for $200. Interest payable is credited for $200. Again, there was nothing on the trial balance, so those are zeros. We make our adjustments, and now we have an ending balance in those accounts. Accrued revenues are just like accrued expenses. The only difference is someone owes us money for something, whether it's rent, whether it's interest, insurance, whatever. They owe us money. And just like interest expense, as soon as we make the loan, interest revenue starts accruing, just like I said on the last slide. Now, at the beginning, like the chapter 1 introduction video, I talked about, hey, let's lend somebody some money. Let's lend them $5,000, and we made that journal entry. So assume that $5,000 we lent to another company, which was more risky than us. We're going to charge them 8%, and that was outstanding for 1 month. So now we need to figure out, okay, how much interest revenue are we due? So we take the 5,000 times 18% times 1 divided by 12, and we end up with $75 as our interest revenue. So we're going to credit interest revenue. We're going to debit interest receivable. And then there's our T accounts. Then we had 0 trial balance, and then we make our adjustments so we have an ending balance of $75 in each account.